Stop what you're doing right now. October 2025, Jamie Dimon used a word that should have terrified every investor in America. One word, cockroach. When you see one cockroach, he said, there are probably more. He wasn't talking about his kitchen. He was talking about the $2 trillion shadow banking market that nobody's watching. And I just spent 72 hours tracking what happened after he said that. 2 companies went bankrupt, Tricolor, First Brands, both backed by private credit. Then I found JPMorgan's exposure, $160 billion. Then I found the Fed's emergency response. They reversed policy, stopped quantitative tightening, started quantitative easing. In December, quietly, no announcement. And yesterday I confirmed the cascade has started. Blue Owl Capital down 18%, KKR down 14%, Ares Management down 16%, private credit firms are diving, and the banks are exposed. This is John A.G. It's Thursday, February 6th, 2026. Jamie Dimon was right. The cockroaches are multiplying, and the $8.5 trillion collapse has already begun. Let me show you the smoking gun. Because this isn't speculation. This is documented evidence that the next financial crisis is happening right now in the shadows. October 18th, 2025. JPMorgan Chase quarterly earnings call. Jamie Dimon is answering analyst questions about credit exposure, and he drops this line. Quote, we've seen a couple of defaults in the private credit space, particularly in the auto sector. And when you see one cockroach, there are probably more. We're monitoring this very closely. Wall Street heard that line and moved on. Analysts wrote it off as Dimon being cautious. But I went back and analyzed what he was actually saying. Because Jamie Dimon doesn't use words like cockroach accidentally. He's the CEO of the largest bank in America. He has access to real-time data that we don't see for months. He sees the loan applications. He sees the wire transfer failures. He sees the margin calls happening behind closed doors. And when he uses the word cockroach, he's telling you there's an infestation you haven't found yet. 2 weeks before that earnings call, 2 companies declared bankruptcy. Tricolor Auto Group, September 27th, 2025. $1.4 billion in debt. Backed by private credit lenders, First Brands Group, October 3rd, 2025. $750 million in liabilities. Also private credit backed, both in the auto sector, both financed by non-bank lenders, both collapsed within a week of each other. And here's what nobody connected at the time. Those weren't just 2 random bankruptcies, those were canaries in the coal mine. Because private credit doesn't work like traditional bank lending. When a bank makes a loan, regulators force them to hold capital reserves. They have to mark the loan to market value every quarter. They have to disclose their exposure, there's transparency, there's oversight. Private credit has none of that. It's called private for a reason. Pension funds, insurance companies, sovereign wealth funds lending money to risky borrowers with zero regulatory oversight. And the firms managing those loans, they get to mark their own homework. They decide what the loans are worth, not the market, not regulators, them. So when Tricolor and First Brands went bankrupt, private credit firms didn't have to immediately write down their portfolios. They could keep pretending everything was fine. They could keep telling their investors the loans were worth 95 cents on the dollar, even though the borrowers were dead. This is mark-to-model fraud. And it's legal. That's what Dimon saw. He saw 2 cockroaches. He knew there had to be more. And now, 4 months later, I can show you the infestation. Let me walk you through what private credit actually is. Because if you don't understand the structure, you can't see why it's about to collapse. Private credit is direct lending by non-bank financial institutions. After the 2008 financial crisis, regulators cracked down on banks. They said you can't make risky loans without holding massive capital reserves. So banks pulled back from risky corporate lending, and private credit firms stepped in to fill the gap. The pitch was simple. We can give you money faster than a bank. We don't have the same regulatory constraints. We can structure creative deals. And for a decade, it worked. The market exploded. From $40 billion in 2000 to $3.4 trillion in 2025. Projected to hit $4.9 trillion by 2029. That's faster growth than subprime mortgages before 2008. And just like subprime, it's built on a foundation of garbage loans disguised as investment-grade paper. Here's the mechanism that's about to break. Private credit firms raise capital from institutional investors. Pension funds, insurance companies, endowments. They tell these investors, we'll give you 8% to 12% annual returns with low volatility. Then they take that capital and lend it to mid-sized companies at 12% to 18% interest rates. They pocket the spread. Everyone's happy until the borrowers can't pay. And that's happening right now. The International Monetary Fund released a report in 2025. They found that 40% of private credit borrowers have negative free cash flow. That's not a recession scenario. That's current reality. 40% of the companies in this $3.4 trillion market cannot cover their interest payments from operating income. They're borrowing to pay interest. That's a Ponzi scheme. And it gets worse because private credit firms don't just make loans and hold them. They leverage the loans. They borrow money against the loans to make more loans. It's called fund financing, and the banks provide it. This is where JPMorgan's $160 billion exposure comes from. Let me show you the exact number because this is terrifying. JPMorgan disclosed for the first time in their January 13th, 2026 earnings presentation their total lending to non-bank financial institutions. $160 billion, that's loans to private credit funds. Loans that are collateralized by the loans those funds made to companies. It's leverage on leverage on leverage. If the underlying borrowers default, the private credit fund can't pay JPMorgan. JPMorgan has to seize the collateral. But the collateral is worthless because the borrower is bankrupt. The loss cascades. And it's not just JPMorgan. Total bank loans to non-depository financial institutions hit $1.14 trillion in 2025, according to the Federal Reserve Bank of St. Louis. That's triple the level from 2018. The banks have re-exposed themselves to the exact same risk that blew them up in 2008. Except this time it's called private credit instead of subprime mortgages. Now let me show you the Fed's emergency response, because this proves the crisis already started. The Federal Reserve ended quantitative tightening in October 2025. They stopped shrinking their balance sheet. Then in December 2025, they quietly restarted quantitative easing. They started buying assets again, expanding the money supply, injecting liquidity, and they did this with zero public announcement, no press conference, no emergency FOMC meeting, just a footnote in the weekly balance sheet report. Why would the Fed reverse policy in the middle of what they're calling a strong economy? Why restart QE when inflation is still above their 2% target? Because they saw something breaking in overnight funding markets. They saw irregular spikes in repo rates. They saw banks scrambling for liquidity. They saw the private credit contagion starting to infect the regulated banking system, and they stepped in to prevent a 2008-style freeze. This is the smoking gun that proves the cockroaches are real. The Fed doesn't restart QE because everything's fine. They restart QE because something is on fire and they need to flood the system with cash before it burns down. And now the Department of Justice is investigating. This is breaking news from January 2026. The DOJ opened a probe into valuation practices at private credit firms. They're looking at whether firms are fraudulently marking loans at inflated values to hide losses. They're looking at whether firms are misrepresenting risk to investors. This is the same playbook from 2008. Regulators ignored the subprime fraud until it was too late. Then they opened investigations. Then they found systematic lying. Then the market collapsed. We're in the investigation phase right now, which means the collapse phase is next. And I can show you it's already starting. Look at the stock prices of the firms most exposed to private credit. Blue Owl Capital, October 2025 high, $24.50 per share. Current price as of February 5th, 2026, $14.20, down 42%. KKR, October high, $148. Current, $92, down 38%. Ares Management, October high, $182. Current, $118, down 35%. Blackstone, down 28%. Apollo Global, down 31%. These are not normal corrections. These are panic exits. Institutional investors are dumping private credit exposure before the contagion spreads. And the redemptions have started. Private credit funds are seeing outflows for the first time since the asset class went mainstream. Investors are asking for their money back. But here's the problem. Private credit is illiquid. The loans can't be sold quickly. The funds can't return capital without taking massive losses. So they're doing what money market funds did in 2008. They're suspending redemptions. They're gating investors. They're saying you can't have your money back right now. We need time to find buyers. That's the definition of a run on the bank. And once redemptions start, they accelerate, because the first investors out get paid. The last investors out get nothing. It's a race to the exit, and the exit is too small for everyone to fit through at once. Let me show you the 2008 parallels, because if you lived through the financial crisis, this should feel familiar. In 2007, two Bear Stearns hedge funds collapsed. They were invested in subprime mortgages. Wall Street said it was contained, just two funds, not systemic. Then Countrywide Financial needed a bailout. Wall Street said it was isolated, just one lender. Then Northern Rock had a bank run in the UK. Wall Street said it was a British problem. American banks are fine. Then in March 2008, Bear Stearns collapsed. JPMorgan had to buy them in an emergency weekend deal arranged by the Fed. Wall Street said, okay, that's the worst of it. It's over. Then in September 2008, Lehman Brothers filed for bankruptcy. Merrill Lynch got emergency acquired. AIG needed a $180 billion bailout. Washington Mutual failed. Wachovia failed. The entire global financial system froze. Credit markets stopped functioning. Governments had to inject trillions to prevent total collapse. We're in the Bear Stearns hedge fund phase right now. Tricolor and First Brands are the canaries. The private credit funds suspending redemptions are the next domino. And when a major fund fails, when a brand name firm like Blue Owl or KKR has to write down 50% of their portfolio, that's when the cascade becomes unstoppable. Let me give you the timeline I'm tracking. February 2026, present day. Private credit stocks down 30% to 40%. Redemptions starting. DOJ investigating. This is stage 1. Awareness March to April 2026. A major fund suspends redemptions permanently. They can't meet withdrawal requests. They announce they're liquidating at distressed prices. Investors panic. This is stage 2. Contagion begins. May to June 2026. Banks start disclosing losses on their lending to private credit funds. JPMorgan writes down $10 billion to $20 billion. Other banks follow. Credit rating agencies downgrade private credit bonds. This is stage 3. Bank exposure revealed. July to September 2026. A systemically important private credit firm fails. Maybe Blue Owl, maybe Ares. The Fed has to decide whether to bail them out. If they do, moral hazard. If they don't, contagion spreads. This is stage 4. The Lehman moment. By end of 2026, we're either in full crisis mode with government bailouts and emergency liquidity programs, or the Fed has successfully contained it through massive money printing. Either way, the private credit boom is over, the leverage unwinds, the defaults cascade, and the $3.4 trillion market shrinks back to a fraction of its peak. Now let me tell you what this means for you. If you have money in a pension fund, an insurance policy, or an endowment, you have exposure to private credit whether you know it or not. These institutional investors put billions into private credit funds chasing higher returns. When those funds take losses, your retirement account takes losses. You don't see it immediately because they don't mark to market. But the losses are real. If you work in finance, real estate, or any sector dependent on credit availability, you're about to see a freeze. Private credit was filling the gap left by banks. When private credit collapses, that gap reopens. Companies that need financing won't be able to get it. Defaults accelerate, layoffs follow. If you own stocks in banks or private credit firms, you're holding the bag. JPMorgan, Bank of America, Citigroup, all have exposure. When they disclose losses, stock prices will crater. Blue Owl, KKR, Blackstone, Apollo, Ares, all of them will see continued selling pressure as investors flee. If you're holding cash, you're about to see the Fed print trillions to prevent a complete meltdown. That means inflation, that means dollar debasement, that means your purchasing power gets destroyed to bail out private credit investors who chased yield into garbage loans. Here's what I'm doing. I'm tracking 4 signals in real time. Signal 1, fund redemption announcements. The moment a major private credit fund suspends redemptions, stage 2 begins. Signal 2, bank loan loss disclosures. JPMorgan reports earnings in April. I'm watching for private credit write-downs. Signal 3, Federal Reserve balance sheet. If QE accelerates, it means the crisis is worsening behind the scenes. Signal 4, junk bond spreads. When credit spreads blow out, it means investors are pricing in defaults. I'll update as these signals flash. But here's the bottom line. Jamie Dimon saw 1 cockroach in October. I just showed you the infestation. 2 bankruptcies became redemption freezes. Redemption freezes became stock price collapses. Stock collapses are becoming bank exposure. Bank exposure will become systemic crisis. The $8.5 trillion private credit and shadow banking collapse has already begun. The Fed is quietly printing money to contain it. The DOJ is investigating fraud, and institutional investors are running for the exits. This is not 2008. This is worse, because in 2008 we had regulatory frameworks to deal with bank failures. We had FDIC insurance. We had the Fed as lender of last resort to regulated institutions. Private credit exists outside that system. There's no backstop. There's no deposit insurance. When these funds fail, investors lose everything, and the contagion spreads to the banks who lent to them. This is the shadow banking crisis everyone warned about, and it's happening in real time while the S&P 500 is near all-time highs. The disconnect is staggering. The market is priced for perfection. The credit markets are priced for disaster. One of them is right. History says it's the credit markets. Because credit leads equities. Credit breaks first. Stocks follow. We're in the credit break phase right now. The equity collapse comes next. This is John A.G. I spent 72 hours tracking Jamie Dimon's cockroach. I found the infestation. $160 billion JPMorgan exposure. $1.14 trillion total bank exposure. 40% of borrowers with negative cash flow. Fed emergency QE restart. DOJ fraud investigation. Stock prices down 30% to 40%. Redemption starting. The cascade has begun. You have weeks, maybe months, before this becomes front page news. By then, the exits will be blocked. The redemptions will be frozen. The losses will be locked in. Position now. Understand the timeline. Track the signals. This is not fear-mongering. This is forensic analysis of a crisis already in progress. The cockroaches are multiplying. And Jamie Dimon was right.